Okay, so before digging into the systematic internalizer regime, I would like to get you through, or maybe for some of you it's really, obvious, and you have you already had very good knowledge of MiFID 1, maybe you have a very good knowledge of MiFID 2, but as I was not entirely sure of the audience, I wanted to give you a few reminders on MiFID in general. So as you know, MiFID 2 is a successor to MiFID 1, which was introduced in 2007, and which covered basically 5 areas, which are still covered in MiFID 2, but have been, in a way, deepened. The first topic is conduct of business and organizational requirements for investment firms. The second pillar is the authorization requirements for regulated markets. The third one is the regulatory reporting to avoid market abuse. Then the trade transparency obligation for shares and the rules on the admission of financial instruments to trading. So that was MiFID 1 scope, and we will see that MiFID 2, on the one hand, furthered or deepened those pillars, but in addition, added other pillars and obligations. So in 2014, the European Commission and the other institutions started or agreed the revision of MiFID 1. And so MiFID 2 entered into application on the 3rd of January, so just 2 months ago. So it's very fresh, still very fresh for all the investment firms and the banks and other institutions which are subject to MiFID 2. So, MiFID 2 has been, for all the banks, really a very significant project. For all the businesses in markets. It has been, to give you an idea, we started the project in my bank 3 years ago. So it has been extremely intense. It covers an immense variety of issues, from investor protection to market structures. And basically, you have those two big pillars in MiFID 2, investor protection and market structures. And we're going to touch the two aspects over those 2 days. So here on the slide, you can see basically the wide variety of topics, of subjects that are covered under MiFID 2. I'm sure you know most of them, and we're going to go through most of them, not all of them, but we're going to dig into most of them during this seminar. I will talk now, during this session, primarily market structures, right? And some of my co-panelists will cover investor protection rules. So when you talk market structures, you have to have in mind that, again, in MiFID 1, you had basically, it covered, mostly equity and, regulated markets and multilateral trading facilities, right? MiFID 2 introduced a new category of venue called Organized Trading Facility, for OTFs. And important to remember already now, the OTF is restricted to non-equity, right? So you don't trade shares in an OTF. I mean, that's very important to remember, but we'll come back to that afterwards. So, MiFID I, regulated market, multilateral trading facility as multilateral trading venues. MiFID II adds organized trading facilities as another type of multilateral trading venue. Then you have also what we call bilateral venues, and that's where comes the systematic internaliser concept, and we'll dig into that concept later on in the presentation. You've got a lot of concepts, acronyms. We'll get back to those afterwards, but I'm sure you've heard of the legal entity identifier for LEI, the notion of liquidity of the financial instrument. That's very important. We'll get back to that. You have, you'll know about the systematic internalizer for SI. The SSTI, SAS specific to the instrument, which is also an important concept for the SI and for the transparency obligation. The LIS, large in scale concept. We'll get back to those afterwards, but those concepts, you need to get familiarized to those if you are practicing MiFID II. Now, as far as the systematic internalizer concept is concerned, we'll get back to it afterwards in more details, but I mean, under MiFID I, the concept of SI was already there for the equity financial instruments, but it was not precise enough. In the regulation at the time, under MiFID I, there were no quantitative criteria at the time. So actually, a lot of firms were able to sort of avoid being qualified as a systematic internalizer, and that's why the European Commission introduced those quantitative criteria and got more precise on the qualification and the definition of the concept. Now, as far as the related obligations are concerned, be it multilateral trading venues or be it systematic internalizer, and sometimes pure investment firm, which not even qualify as systematic internalizer, you've got a lot of related obligations. You've got transparency obligations, pre-trade, post-trade transparency obligation, transaction reporting obligation. We'll get back to that afterwards, but you have to fulfill those obligations whether you be a multilateral trading venue or whether you be a systematic internalizer, and even sometimes just an investment firm. You've got, again, lots of reports. You've also reports on the quality of execution that you have to fulfill. You have also the trading obligation for shares and the trading obligations for derivatives. This subject, the trading obligation is a subject for a later session. Okay, so here is a slide, comparing, the venues pre and post MiFID II. Again, you see under MiFID I, you've got all the venues, be it multilateral or bilateral. For multilateral, again, regulated markets, multilateral trading facilities, but limited to equity, because MiFID I is limited to equity. Then, under MiFID II, you have the regulated markets, MTFs, and also a new type of venues, as I said already, the OTF, for organized trading facilities for non-equity instruments, again. And on the bilateral side, you have the SI, Systematic Internaliser, again under MiFID 1, limited to equity, and under MiFID 2, extended to equity-like instruments like ETFs, exchange-traded funds, for example, but also certificate of deposits, for instance, and the whole non-equity world, so debt instruments. And then what I call OTC, I could have said pure, what I would call pure OTC. I mean, it's OTC trades, so over-the-counter trades, bilateral trades that are not traded by systematic internalizers. This, OTC, I mean, the scope for OTC is being more and more reduced, and that's a consequence of the financial crisis in 2008. I mean, regulators post-crisis have been willing to reduce as much as possible the scope for, OTC trading. So there is a trend, as you know, to go for standardized products, especially in the derivative world, to subject them to the clearing and trading obligation, at least for some of them. So over time, I mean, the intention of the regulators is really to reduce the scope of OTC transactions mostly for transparency, market transparency reasons. Okay, so now let's dig into the SI concept. So what is an SI? So first, it's an investment firm, right? I mean, investment firms, most of, many, and I would say, most of the banks would be qualified as investment firm in addition to their banking license. So it's an investment firm who trades on an organized, frequent, systematic, and substantial basis, which deals on own account, contra, client account, when executing client orders, outside of a regulated market, an MTF or an OTF, and without operating a multilateral trading system. Now, that's what I told you. This is all fine, but if you stop there, how would you, determine what is organized, frequent, and systematic? And that's what the Commission did under MiFID 2, is providing more clarity on the definition of what frequency and systematic is. So it provides a definition on the frequent and systematic basis and on the substantial basis. On the frequent and systematic basis, the test is the number of OTC trades in the financial instrument carried out by the investment firm on own account by executing client orders. And it's important to specify here that you can be, theoretically, you can be an SI on some types of financial instruments and not on others, right? Could happen. So it depends on, the thresholds that are fixed by ESMA. Then you have the substantial basis criterion, which is measured either by the size of OTC trading carried out by the SI in relation to the total trading of the SI in a specific financial instrument. So again, it is determined by financial instruments, or by the size of the OTC trading carried out by the SI in relation to the total trading in the EU in a specific financial instrument. Well, the obligation, the qualification as SI and the related obligations for SI will only kick in from next September. So because, in order to determine the SI status, the market operators, the investment firms need, to get data, market data, which are actually gathered by ESMA. ESMA will put those data at the disposal of investment firms, and that's on the basis of those data. You can see in those formulas that you need those market data, and those market data will only be available next summer. So actually, the obligation to qualify as an SI has been postponed to next September. But many investment firms have decided to opt in for the SI status on a voluntary basis, and primarily actually for commercial marketing reasons. Large investment firms have decided to opt in for that status because as an SI, basically, and you will see that in the next session on post-trade transparency, but as an SI, you get the obligation to report, the data of a trade to the market, and you do it, so the responsibility falls on you and not on your counterparty. So actually, many firms use that as a commercial incentive vis-à-vis their clients. Say, well, look, we are a SI and we're going to do the reporting for you. And that's quite important for the buy side because the banks have been used to put all the plumbery in place, the workflows for reporting. It's extremely cost intense, and it requires many IT and operational developments that many buy-side firms would not be willing to invest in. So actually, Société Générale, for instance, is already an SI because we've opted for that status for most of our financial instruments we're trading. And that's the case of many of comparable financial institutions. Okay, so the scope of the product scope of SIs. So as I said, and sorry, I keep repeating things. Sorry for that, but I think it's quite important to repeat those things and concepts. But again, equity, well, extension from equity under MiFID 1 to equity-like instruments. So again, ETFs, certificates, depository receipts are equity-like instruments, and non-equity instruments, derivatives, bonds, structured finance products, emission allowances, all those products are non-equity instruments. So an extremely broad scope of financial instruments under MiFID 2. Okay, well, once you become an SI, once you qualify as an SI, be it on a voluntary basis, as many banks have decided to, or if you're forced to become an SI because you reach the thresholds according to the formulas I have shown you, then, well, once you get that status, well, that's all fine, but then, you get the number of obligations to fulfill. And one of those obligations, and I want to spend some time on that one because we will not have a subject dedicated to it in this seminar. So I'd like to give a few words on that. It's what is called Pretrade Transparency, because that's a huge change for the markets and for the banks, but for financial markets in general. Especially in the non-equity world, which used to be pretty much an OTC world, right? So what is pre-trade transparency? I mentioned public firm quotes. When you are an SI, so Société Générale, for instance, or any other financial institution which is an SI, will have to publish, make it public to the whole world, it's, firm quotes, on, financial instruments. So it will have to publish, for transparency reason, its quotes. And, once, the Systematic Internaliser has published its quotes for liquid products. I mean, that's important to specify, is that, you still have, a wide range of what is called illiquid products. I mean, the liquidity criterion is determined, according to some, also threshold criteria. But once a product is deemed liquid, the firm, the Systematic Internaliser, has to publish all its quotes. That means that, the whole world can see, the quotes of products of every Systematic Internaliser. And once you publish your quotes, you have to offer, to your other clients. Well, let's say a client has asked you a quote, right? You give the quote to the client, and as you have to publish your quote to the whole world, any client of yours, which see that quote, can, or no, not can, but must be able to trade, with you at that quoted price. And so that's a sort of revolution for the non-equity world, where, everything was, quite bilateral and, with not so much transparency, to the whole market. So now, it's a huge change. It's a huge change. It will really transform, market practice of operators. So that's a real change for the markets. Now, it doesn't mean you have to give access to those quotes to all your clients. Basically, you have to do it for all the clients of the same category. So it means that every firm, so there is still a limit, is that every firm can develop its own commercial policy, with some objective criteria. So they would, the financial institution would actually tier its clients. And, according to objective criteria, be it, credit rating, for example, or, other objective criteria, according to which all the clients, meeting those criteria would have to get access to those quotes, So that's really a big, I would say, a revolution for the non-equity world. Okay, on that slide, you get a comparison of the trading venues, and you can see, the various criteria per venue. So if you take, for example, the product scope, so you can see equity or equity-like products can be traded on every venue, be it multilateral or bilateral, except the OTF, as we said, right? OTF is only for non-equity. I will not go through all of them, but again, if you look at, for example, transparency at the bottom of the slide, pre-trade transparency for all, it's an obligation for all venues, except well, the non-SI investment firm, well, the investment firm is not a venue, right? We call the SI a bilateral venue, but the investment firm which does not qualify as an SI is not a venue. But so no pre-trade transparency on some still OTC products which are not traded through an SI or not traded through a trading venue. No pre-trade transparency obligation. But for post-trade transparency, that's for everyone. So post-trade transparency is transparency to the market, and that's for everyone, including the investment firm, which does not qualify as an SI. So that's important to remember. And also, we should never confuse post-trade transparency and transaction reporting. We're going to touch that later on today, but post-trade transparency is transparency to the market. Transaction reporting is reporting to the regulators. We'll get back to that afterwards. Okay, so quick overview, but we'll get back to those later on today. So I don't want to, well, except pre-trade transparency, but I've discussed it previously. So pre-trade transparency is the obligation to publish in real time prices and amounts for selling and buying interest related to in-scope financial instruments. Post-trade transparency is obligation to publish post-trade a report when a transaction on an in-scope financial instrument is concluded, again, reporting to the market. Equity and equity-like instruments under MiFID are shares, depository receipts, ETFs, certificates, and similar financial instruments that are traded on a trading venue. And non-equity instruments under MiFID is a very large, a very broad category. It includes bonds, structured finance products, emission allowances, and derivatives. Okay, I will not enter into all the details of this, but you must know that there are some systems of, exception or exemption, or I should call it, deferrals for pre- and post-trade transparency, and also some waivers, but we'll get back to that later today. Okay, so that's a last slide in a nutshell. So if you want to, remember a few key features for the SI. So again, SI stands for Systematic Internaliser. It's a status for investment firms, either on a mandatory basis from September this year, whether or if the investment firm reaches some thresholds, then the investment firm will qualify as an SI, and it will be an obligation. The status or the calculation of the threshold is determined by financial instruments, so investment firm can be an SI on some financial instruments and not on others. Firms can opt in, as I said, and many banks did. They opted in for the SI status, as I said, mostly for commercial purposes. If you become an SI, be it on a mandatory or a voluntary basis, you get some very strict obligations to fulfill, mostly in terms of transparency, pre, post-trade, and transaction reporting to the regulators. And you also have some other obligations, obviously, that will be developed later on, but you have also some investor protection obligation you have to fulfill, for example, the best execution obligation that will be discussed later in the seminar. So that's it for the SI concept. Are there any questions